Hello everyone, welcome back to Swadhyay. In the last video, we have completed revision of the chapter Income from Capital Gains. Today, we are going to revise the chapter Income from Other Sources. This is the last head of income, and the charging section for this chapter is section 56. Section 56 states that income which is not exempt, not a capital receipt, and not covered under any other head is taxed under the head income from other sources. Incomes which are not exempt, which are not capital receipts, and which are not covered under any other head is taxed under the head income from other sources. Hence, it is also known as residuary head. So, how is income computed? Let us see. There are various types of income under this head. The first one is dividend income. So, the dividend income is taxable under the head income from other sources. Whenever a company declares dividend to its shareholders, the previous year in which such dividend is declared, the dividend income will be taxable for such shareholders. The dividend income is taxable in the hands of shareholders. Also, there is a concept called deemed dividend. So, what includes deemed dividend? Deemed dividend is also taxable under the head income from other sources. So, what all include deemed dividend? Let us see. The first one is distribution of accumulated profits entailing the release of company's assets. When the accumulated profits are distributed by releasing the company's assets, it is deemed as dividend. The second point is distribution of debentures, deposit certificates to shareholders, and bonus shares to preference shareholders, whether with or without interest. When debentures or deposit certificates are distributed to shareholders and bonus shares are distributed to preference shareholders, it is deemed as dividend. The third point is distribution on liquidation. To the extent to which the distribution is attributable to the accumulated profits of the company immediately before its liquidation. So, when the assets are realized and the funds are distributed among the shareholders at the time of liquidation, to the extent of accumulated profits, amount attributable to the accumulated profits, it is deemed as dividend. Note, any distribution made out of the profits of the company after the date of liquidation cannot amount to dividend. It is a repayment towards capital. So, till the date of liquidation, whatever accumulated profits are there, the money which has been distributed to such extent is deemed dividend. But after the date of liquidation, whatever profits are left with the company, if they are distributed, it is treated as repayment towards capital and not as deemed dividend. Distribution on reduction of capital. To the extent to which the company possessed accumulated profits. On reduction of capital, when distribution of funds is made among the shareholders, to the extent of accumulated profits only, it is considered as deemed dividend. Advance or loan by a closely held company to its shareholders. Any payment by a private company of any sum by way of advance or loan to any shareholder who is the beneficial owner of 10% or more of the equity capital of the company will be deemed to be dividend to the extent of accumulated profits. If a private company is advancing any sum, it is giving any loan to the shareholder. Such shareholder has beneficial ownership of 10% or more of the equity capital of the company. If company is advancing any payment to such shareholder, then it will be deemed as dividend to the extent of accumulated profits. If the loan is not covered by accumulated profits, that is excess of amount of accumulated profits, whatever the amount is advanced by the private company to its shareholder, it is not deemed to be dividend. Also, any payment by a private company to any concern, which might be HUF, firm, AOP, body of individuals or a company, in which a shareholder having the beneficial ownership of at least 10% of the equity shares is a member or a partner, and in which he has a substantial interest, that is at least 20% share of the income of the concern, will be deemed to be dividend. Here, if the private company is having a shareholder who is holding beneficial ownership of at least 10% of the equity shares, as well as he is member of any concern, he is a partner of any concern, and in such concern the same shareholder is having substantial interest. Here the substantial interest in such entity means at least 20% of share of income of the concern. So the shareholder he is obliged to receive at least 20% share of the income of the concern. In such a case, when such shareholder is holding substantial interest in such entity, and this private company is advancing some amount to such entity, which might be HUF, firm, AOP, BOI or company, then it will be deemed as dividend. I hope it is clear for you. There are few exceptions. The cases where any amount paid by the companies to the shareholders is not treated as dividend. Let us see what are those cases. The first one is distribution in respect of non-participating shares issued for full cash consideration. So if a shareholder is holding non-participating shares, he is the company pays that shareholder a fixed rate of interest rather than the share of company's profit. Fixed rate of interest or amount is paid to the shareholder instead of part of company's profits. So any distribution made to such non-participating shareholders is not treated as dividend. Payment made by company on buyback of shares is not treated as dividend, as well as distribution of shares to the shareholders on demerger by the resulting company is also not treated as deemed dividend or dividend. Suppose let us take a case where the assessee has taken loan for investment into shares of a company. In such a case, there is a deduction the assessee can avail in respect of such interest paid on loan. Interest paid on loan taken for investment in the shares to earn dividends up to 20% of grossed up value. The condition to claim deduction is that when dividend income is earned by taking loan, the interest on such loan can be claimed as deduction, but the maximum amount of deduction that the person can claim in respect of interest paid on such loan, it should not exceed 20% of dividend income which has been earned. The income which has been earned on investments, out of that only 20% of amount can be claimed as deduction with respect to interest paid on loan taken for investment. I hope it is clear for you. The second type of income in this chapter is casual income. Casual income means any income from winnings from lotteries, crossword puzzles, races including horse race, card games and other games, gambling, betting, etc. Here the income, other than winning from any online game, all these incomes are taxed at the rate of 30% of such winnings. Plus surcharge is also added if applicable, and we also add health and education cess at the rate of 4%. The conditions for taxability of casual income is no allowances from such income. That means no expenditure is allowed from such income. There is no deduction of expenditure from such casual income. Also, deduction under chapter 6A is also not allowed. Assessee cannot claim any deduction under chapter 6A from this casual income. Adjustment of unexhausted basic exemption limit is not permitted, which means what we do while taxing the casual income is, while calculating the tax for casual income is, first we will calculate the income of assessee from all the other heads. As per the basic exemption limit, we are going to take as gross total income. To that, we are going to add the casual income. So for casual income, we are not going to see the basic exemption limit, the basic exemption limit of the assessees. We are not going to provide for any deductions or any expenditure. Directly we are going to tax such casual income at the rate of 30%. This is a special rate tax, a special tax rate income. Also, set off of losses from the casual income is not permissible. Similarly, similar to the casual income, if assessee has any unexplained cash credits or investments, money, bullion, jewelry, etc. or expenditure, in such a case, the tax rate for such unexplained cash credit, all these incomes, is 60% of such income. To that, we are going to add surcharge at the rate of 25% of tax. And to that, we are going to add health and education cess at the rate of 4%. So the effective tax rate for such unexplained income is 78%. Similar to the winnings from lotteries, one more income an assessee can get is from net winnings from online games. For net winnings from online games, the tax rate is 30% of net winnings plus surcharge, if applicable, is added, and to that we are going to add health and education cess at the rate of 4%. So how to determine the net winnings from online games? How to determine the amount of net winnings? Let us see. Net winnings is equal to closing balance of user account at the end of financial year plus aggregate amount withdrawn from the user account during the financial year minus aggregate amount of deposits made into the user account during the financial year minus opening balance of the users online game account at the beginning of the financial year. Here the account we are referring to is the account of the online game. Whatever the closing balance of the account at the end of financial year is there, we are going to add aggregate of amount withdrawn from such account. And we are going to deduct any deposits made into such account during the financial year, and also we will deduct any opening balance of such account at the beginning of the financial year. So we will arrive at net winnings amount, and such amount will be taxable at the rate of 30% plus surcharge is added if applicable, and also health and education cess at 4% is also added. Heading to the next income. The third one is consideration received in excess of fair market value of shares of a closely held company, where such shares are issued at a premium. Here, shares are issued at premium, and the consideration received is excess of fair market value of shares. If a closely held company, being a private limited company, issues shares in excess of their face value, it issued shares at premium to a resident or non-resident person, then the income from other sources for such company, which is taxable in the hands of such company, is issue price of shares minus fair market value of shares into number of shares issued. I hope it is clear for you. The fourth type of income is interest received on compensation or enhanced compensation deemed to be income in the year of receipt. In case of compensation or enhanced compensation, in case of compulsory acquisition of capital asset, if the interest amount is also accrued on such compensation or enhanced compensation and it is received by the assessee, such interest on compensation or enhanced compensation will be taxable under the head income from other sources in the year of receipt after 50% flat deduction. That means first 50% of such interest amount will be deducted and other 50% amount will be taxable under the head income from other sources. The fifth income. It is advance forfeited due to failure of negotiations for transfer of capital asset. In the previous chapter, income from capital gains, we have come across this point. When the capital asset, when any advance money is received by assessee in respect of any sale or transfer of capital asset, but it is forfeited due to failure of negotiations between the parties. In such a case, whatever the advance money is lying with the assessee, it will be taxable under the head income from other sources in the year of receipt itself. But such advance money should have been received by the assessee on or after 1st April 2014. Any advance money received and forfeited by any person due to the failure of negotiations for transfer of capital asset on or after 1st April 2014 is taxed under the head income from other sources in the year of receipt. The sixth type of income is sum of money or property received by any person. Simply put, any gift is received by any person. Let us see the first case where the asset received is cash. When cash is received as a gift, that means without any consideration, the taxable value will be the whole amount if the cash amount received exceeds rupees 50,000. If assessee receives cash with, in excess of rupees 50,000, the whole amount which is received by the assessee will be taxable. If it is a movable property, a movable property is received by an assessee without paying any consideration. In such a case, the aggregate fair market value of the asset, if it exceeds rupees 50,000, will be taxable. If the movable property carries aggregate fair market value which is greater than rupees 50,000, then the aggregate fair market value will be the taxable value. In case such movable property is received by assessee for inadequate consideration, assessee has paid some amount, but such consideration is inadequate when compared to the value of such movable property. In such a case, we have to see the difference between consideration paid minus aggregate fair market value. The difference between consideration paid for such movable property and aggregate fair market value of such movable property. If it exceeds rupees 50,000, such difference amount will be taxable value. Here the difference amount will be taxable value. Only if the consideration minus aggregate fair market value of such movable property exceeds rupees 50,000. Then let us see the case of immovable property. If immovable property is received by the assessee without any consideration, he has not paid any consideration. If the stamp duty value of such property exceeds rupees 50,000, then the stamp duty value will be the taxable value. If such immovable property is received by assessee for inadequate consideration, in such a case, the difference between consideration and stamp duty value of the property, if it exceeds either 50,000 or 10% of the consideration, whichever is higher, the difference amount exceeds either 50,000 rupees or 10% of consideration amount, whichever is higher, then the taxable value will be the difference between consideration and stamp duty value of the property. Here, since we are talking about stamp duty value, the SDV on date of registration should be considered. The stamp duty value of the property as on date of registration should be considered. However, if the assessee can opt to take stamp duty value as on date of agreement, instead of SDV on date of registration, assessee can take SDV value as on date of agreement only if on the date of agreement either whole or part consideration is paid, either by way of account payee check or account payee bank draft or electronic clearing system or any prescribed electronic mode. If consideration is paid in as a whole or in part on the date of agreement, then SDV on date of agreement will be taken, but the payment should be made either by way of account payee check or account payee bank draft or electronic clearing system or any prescribed electronic mode. Also, if valuation officer has been referred to assess the value of property by assessing officer on any claim of assessee, then value referred by valuation officer if it is less than stamp duty value. the value assessed by valuation officer is considered. But if value referred by valuation officer is higher than SDV, then stamp duty value will be considered while computing the taxable value of such property. I hope it is clear. When these properties, be it cash or movable property or immovable property, are received by assessee, in following cases, there will be no tax liability. The above circumstances, the income received or assets received in above circumstances are not taxable under the following circumstances: if they are received from any relative, or if they are received on occasion of marriage of the individual, or under a will or by way of inheritance, or in contemplation of death of the payer or donor, or from any local authority, or from any fund or foundation or university or other educational institution or hospital or other medical institution or any trust or institution, or from or by any trust, institution registered by any fund or trust or institution or any university, other educational institution or any hospital or other medical institution, or by way of transaction not regarded as transfer under section 47, or from any individual by a trust created or established solely for the benefit of relative of the individual. In these cases, when the property or money is received by the assessee, it is not taxable. Here in the first point we have mentioned the word relative. Let us see who are the persons who cover under the definition relative. For individual, relative means his spouse, siblings, lineal ascendant or descendant, siblings of his spouse, lineal ascendant or descendant of his spouse, as well as siblings of either of his parents, and spouse of any of the above persons. These people are considered as relatives for any individual. And any gift in form of money or asset is when it is received by assessee from these persons, it is not taxable. For HUF, any member is considered, any member of HUF, any member of the family is considered as the relative. There are few special circumstances where money received by individual is not taxable. Let us see those circumstances. If the money is received by any individual from any person in respect of any expenditure actually incurred by him on his medical treatment or for his family member for any illness related to COVID-19 subject to following conditions by central government. When the money is received by individual to cover the medical expenses incurred by him on either his treatment or treatment of his family member, when they are sick due to COVID-19 or any illness related to COVID-19. In such a case, the CJ has prescribed following conditions to be met. The individual has to keep following documents. Number 1, the COVID-19 positive report or medical report of the individual or his family member, and all necessary documents of medical diagnosis or treatment of the individual or family member due to COVID-19 or illness related to COVID-19 suffered within 6 months from the date of being determined as COVID-19 positive. If the individual keeps these documents, he can claim he has incurred any medical expenditure on the treatment of COVID-19 or any related illness. If he is receiving any amount from any person to cover such expenditure, such amount will not be taxable. The details of the amount received in any financial year has to be furnished to the income tax department within 9 months from the end of such financial year. Similarly, if any money is received by a member of family of a deceased person and the cause of death is COVID-19, in such a case, if the sum of money is received from the employer of the deceased person, then there is no limit. But if the money is received from any other person or persons, then the limit will be rupees 10 lakh. if the amount is received by the member of family of a deceased person from any other person or persons to the extent that such sum or aggregate of such sum does not exceed, it is less than or equal to rupees 10 lakh. It is not taxable. And the payment should have been received within 12 months from the date of death. This is one important point to be noted. The central government has prescribed conditions to claim above exemption. The death of the individual should be within 6 months from the date of testing positive. The family member has to keep the documents as COVID-19 positive report of the individual or medical report or death certificate issued by the medical practitioner or government civil registration office. In such a case, if the documents are maintained by the family members of the individual who has passed away, the exemption can be claimed by the assessee, the member of the family who has received such amount. The details of the amount received in any financial year has to be furnished to the income tax department within 9 months from the end of such financial year. So these are the conditions to claim exemption. That means when the income, any money or assets are received from any other person for no consideration or for inadequate consideration, only under these circumstances such money received or assets received will not be taxable. Compensation or other payment. Let us head to the next income, that is compensation or other payment due to or received by any person in connection with termination of his employment or the modification of the terms and conditions relating thereto. If any compensation or any other payment is paid to any person at the time of termination of his employment or due to modification of the terms and conditions, then it is treated as income from other sources. The next income is sum received including the amount allocated by way of bonus under a LIP, life insurance policy, other than under a ULIP, and Keyman insurance policy which is not exempt under section 10D. Any sum received including the bonus under a LIP other than ULIP and Keyman insurance policy and which is not exempt under section 10D is taxable. First, let us see to what income the exemption is available. The exemption is available as follows. If the policy is issued before 1st April 2003, any sum received on such policy including the bonus is exempt. But if it is between 1st April 2003 to 31st March 2012, any sum received including bonus will be exempt, but the exemption is not available if the premium payable for any year during the policy term exceeds 20% of actual capital sum assured. The premium payable during any of the years during the policy term is exceeding 20% of actual capital sum assured. In such a case, there is no exemption. For policies issued on or after 1st April 2012 but before 1st April 2013, in this duration of 1 year, all the any sum received including bonus on such policy will be exempt, but exemption will not be available if premium payable for any of the years during the policy term exceeds 10% of actual capital sum assured. Similarly, for policies issued on or after 1st April 2013, any sum received including bonus is exempt, but the exemption is not available if the premium payable for any of the years during the policy term exceeds 10% of actual capital sum assured. Generally, if it exceeds 10% of actual capital sum assured, the premium payable, if it exceeds 10% of actual capital sum assured, exemption is not available. But instead of 10%, the limit is 15% of actual capital sum assured in case of disabled persons as referred under section 80U or 80DDB. If the policy is taken in respect of disabled persons referred under section 80U or 80DDB, the limit is 15%. The next case, where the policy is issued on or after 1st April 2023. Any sum received including bonus is exempt. However, exemption is not available if premium payable for any of the years during the policy term exceeds 10% or 15% for disabled persons of actual capital sum assured, or if the amount of premium payable exceeds rupees 5 lakh in any year. Either the premium payable is exceeding 10% or 15% as the case may be of actual capital sum assured, or if the premium amount payable exceeds rupees 5 lakh for policies issued on or after 1st April 2023. Then exemption is not available with respect to any sum received on such policies. Where there are more than one LIPs other than ULIPs held by the assessee, and premium payable on such policies aggregate to rupees 5 lakh. For multiple LIPs, he is paying a premium exceeding rupees 5 lakh. Then exemption would be available for any of those LIPs at the option of assessee whose aggregate premium payable does not exceed rupees 5 lakh. For any LIP whose aggregate premium payable does not exceed rupees 5 lakh, assessee has option to claim exemption. In case assessee is holding multiple LIPs and the aggregate premium payable on such LIPs is exceeding rupees 5 lakh. Here the taxable amount will be sum of money received including the bonus amount minus total premium paid during the policy tenure. This is the taxable amount under the head income from other sources. Also, if any sum is received on death of a person, it is exempt irrespective of annual premium payable on the policy. When such sum is realized on death of any person, it is received on death of any person, it will be exempt irrespective of the annual premium payable on such policy. The ninth income. Deemed income under section 59. Remission or cessation of a trading liability or receipt of any amount in respect of loss or expenditure allowed as deduction an earlier PY, previous year. Any loss or expenditure in respect of which deduction has been provided for in the preceding years, and in subsequent years if any amount has been recovered, and subsequently if in the previous year any amount has been recovered with respect to such loss or expenditure, it will be deemed as income and hence taxable under this head. The 10th income. Any income chargeable to tax under the Act. Any income chargeable to tax under the Income Tax Act, but it is not falling under any other head of income. For example, salary received by an MP or MLA is treated as income from other sources, but any daily allowance or constituency allowance of such MPs or MLAs will be exempt. The salary portion will be taxable under the head income from other sources. With this, we have completed discussing what are the incomes to be added while computing income from other sources. We have discussed about all the 10 incomes. So now let us see the other incomes. The following incomes, if not chargeable under the head PGBP, are charged as income under the head other sources and will be taxable. Any sum received by an employer from his employees as contributions to any provident fund, superannuation fund, or any other fund for the welfare of employees. If it is not taxable under the head PGBP, it will be taxable under the head income from other sources. Interest earned on securities. Any income from letting out on hire of machinery, plant or furniture. The assessor is not in business of letting out machinery, plant or furniture, and if he is earning any income by letting out any machinery, plant or furniture on hire, in such a case it will be taxable under the head income from other sources. Similarly, where letting out of buildings is inseparable from the letting out of machinery, plant or furniture, the income from such letting is also taxable under the head other sources. Here the assessee is letting out a building, but the machinery, plant or furniture are integral part, inseparable part of such building. In such a case, whatever income has earned by such letting out, it will be taxable under the head income from other sources. Any sum received under a keyman insurance policy, including bonus on such policy, if not chargeable to tax under the head salaries, is also taxable under the head income from other sources. After adding up all these incomes, we have to provide for deductions under section 57. Let us see what are the deductions allowable under section 57. In case of dividends or income in respect of units of a mutual fund or income in respect of units from a specified company, the interest expenditure allowable as deduction subject to a maximum of 20% of such income included in the total income for that year without deduction under this section. Which means we have already discussed while revising the dividend concept. The interest expenditure is allowable as deduction subject to 20% of income earned on such investment for which the advance or loan has been borrowed. The second case is in case of interest on securities. Any reasonable sum paid by way of commission or remuneration to banker or any other person. The interest on securities has been earned, but with respect to such interest on securities amount, any reasonable sum is paid in either by way of commission or remuneration to banker or any other person. Such expenditure will be allowed as deduction. Income consists of recovery from employees as contribution to any PF, superannuation fund, etc. Then the amount of contribution remitted before the due date under the respective acts can be allowed as deduction. If the amount of contribution is remitted before the due date, then it can be allowed as deduction under section 57. Income from letting on hire of machinery, plant and furniture with or without building. Income from letting on hire of machinery, plant and furniture with or without building. Any current repairs incurred to such machinery, plant, furniture or building, any insurance premium payable on such assets and depreciation or unabsorbed depreciation with respect to such assets. These three expenditure can be claimed as deduction. Family pension. When a family pension is received, then the assessee will add up such family pension amount and from that amount either 33.1/3% of such income can be claimed as deduction or rupees 15,000, whichever is less can be claimed as deduction. Interest on compensation or enhanced compensation received. We have discussed this point before. When interest is received on compensation or enhanced compensation, 50% of such interest will be taxable and 50% is exempt. Any other expenditure not in the nature of capital expenditure incurred wholly and exclusively for earning such income can be allowed as deduction under section 57. By providing for deductions, we are going to arrive at income from other sources. Now let us discuss section 58, which talks about deductions which are not allowed. Deductions not allowable under section 58 are any personal expense of the assessee, any interest chargeable to tax under the Act which is payable outside India on which tax has not been paid or deducted its source. The interest is chargeable to tax under the Act. It is payable outside India by the assessee, and on such interest TDS has not been deducted its source or TDS amount has not been paid even after deduction. In such a case, such interest is not allowed as deduction. Any payment chargeable to tax under the head salaries if it is payable outside India unless tax has been paid thereon or deducted it. So similar to the case above, if any payment is chargeable to tax under the head salaries and it is payable outside India on which TDS has not been paid or deducted, then it is not allowed as a deduction. Such payment is not allowed as a deduction. Any payment made to related person, to the extent the same is considered excessive or unreasonable by assessing officer having regard to the fair market value. Any payment or expenditure is incurred by the assessee, it is paid to related person, and assessing officer feels that such amount paid is excessive or unreasonable. When compared to the fair market value, such amount is excessive. In such a case, such payment or expenditure will be disallowed as deduction. Any expenditure in respect of which a payment or aggregate payments exceeding Rs 10,000 is made to a person in a day, otherwise than by account pay check or draft or ECS through bank account or through such other prescribed electronic modes such as credit card, debit card, net banking, IMPS, UPI, RTGS, NEFT and Bheem Aadhaar Pay. A payment is made with respect to some expenditure to a single person in a single day and it exceeds Rs 10,000. It is paid otherwise than by following 4 modes. Then such expenditure will be disallowed. Any expenditure or allowance in connection with casual income. Any expenditure incurred with respect to casual income is disallowed as a deduction. But a point to be noted here is, business of owning and maintaining race horses is not casual income. Winnings from horse race is casual income, but the business of owning and maintaining race horses is different. So, such income from such business is not treated as casual income. Income from such business is taxable under the head income from other sources, and expenses incurred with respect to such income are allowed while computing such income. 30% of expenditure in respect of sum which is payable to a resident on which tax is deductible at source, if such tax has not been deducted on or after deduction it has not been paid on or before the due date of return specified in section 139(1). If before the due date TDS has not been deducted or not been paid with respect to any expenditure, any sum payable to resident, then 30% of such expenditure will be disallowed as deduction under section 57, under section 58, sorry. So with this, we have completed revising the chapter income from other sources. In further videos, let us cover the clubbing, the set off and carry forward and set off of losses, and all the other chapters. So please keep watching our upcoming videos, and I hope you find this video helpful. Thank you.